We've talked about Lululemon on this channel before, and they're going to be reporting earnings this week, and I think it's time that we follow up on our most recent discussion about the stock, and we're going to do that today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic. I hope you all had a great Thanksgiving. We have talked about Lululemon many times on this channel before. I've spoken about Lululemon many times on CNBC because it is part of what I have referred to as the Holly Index. The Holly Index are those publicly traded companies whose names appear on our credit card statements. I use it, I guess, kind of the way that Peter Lynch does, as a benchmark of sorts of what discretionary purchases are being made, because I am not much of a shopper. My wife and kids are, and so I sort of use that as my way to sort of take the temperature of consumer discretionary spending and the popularity of certain products. Lululemon, along with companies like Apple, Nike, Tesla, Costco, these were things that I saw quite a lot of. It was for quite a while my wife's favorite athleisure company. More recently, she favors Vuori, but this was her number one for a very long time. And what I talked about on this channel most recently, I think we probably talked about it back on October 24th or thereabouts. I think that's when it was. One of the things I discussed was that when you compared Lululemon to, and I have a chart of it up here, but maybe it's probably better if I actually take a look at valuations, that when you compared it to the Consumer Discretionary Index, when you compared it to the S&P, when you compared it to companies like Nike, I think I'm going to use Nike because that's probably the best comp I can think of, it looked cheap. That is to say that if you took a look at how it was trading as a multiple of its forward earnings, it was trading at a lower turn than most of these others. So for example, the S&P right now trading 25.6 times forward earnings. The Consumer Discretionary Index is trading just under 30 times forward earnings. Nike is trading around 28 times forward earnings. And as of today, it looks like Lulu's trading about 23.8 times forward earnings. It was closer to 21 back in late October when we were talking about it. Now, a multiple on its own is not reason enough. Fundamentals aren't necessarily remarkable trading signals to begin with. And secondly, and this is particularly true for things like cyclical stocks, the multiple may be telling you another story. So for example, if you're trading at a very low multiple, if you're looking at something like Case New Holland, CNH, which trades at it's an industrial that trades at a very low multiple. This is a tractor business to make agricultural equipment, competitor to companies like Deere, for example. You'll notice that it trades at a very cheap multiple. It's $12.50 a share. Probably going to do a little over $1 a share in earnings full year this year. So it's trading very low single digits. There's a reason, and that is that agricultural equipment has been suffering a cyclical downturn on the back of lower commodity prices. A lot of them hit their zenith a couple years ago and have been falling steadily since. That kind of a circumstance, farmers spend less. They have less money coming in. And also, in many cases, when they had very low interest rates and very high crop prices, they may have accelerated purchases. In any case, I had a conversation about whether or not CNH represented an interesting opportunity. Be that as it may, in Lululemon's case, the observation I was making, other than just this multiple issue, was that the company was trading at a discount to Nike, but was forecast to actually grow at a decent pace. So full year consensus, this is sort of the aggregate of all of the analysts who cover it. The estimate was that you're going to see top line growth of about 8.5%. That's for this year. The fiscal year ends at the end of January. 7.6% for next year. So growing, while not as quickly as it had historically, still growing at a pace that exceeded its peers, that exceeded probably the discretionary index overall, that probably exceeded the growth rate for the S&P. Almost 12% year on year. EPS growth, adjusted EPS growth was forecast, and so on. Now, since we made that observation back in late October and said that Lulu was a better alternative to Nike, it has certainly proven to be. So I think I'm just going to go back to the 24th, and we can just take a look at how we're doing. So Lulu's up almost 12% in that time. The S&P is up 4.25%, and Nike is up about 57 basis points. So Lulu has considerably outperformed over that time frame. While I was contemplating that over this weekend, I was taking a look at some of the same alternative data that we've previously looked at, and I was taking a look at some of the observed sales. So as you look at this chart, the red line represents what the analysts' estimates were. So this is sort of just taking a look at the period year over year. So August 5th of this year, the estimate versus last year was that it was going to have fairly modest year-on-year growth. Street was looking for a little better than 3.5%, which, by the way, is much less than the total growth rate that was implied by those larger samples. And basically what's going on here is that the company is slowing from a pace of very high annual growth to much slower growth. The street had generally been expecting it to slow actually to almost nothing, which helps account for the lower turn relative to the S&P and relative to consumer discretionary. Now, this observed sales data, this is just a sample, credit card data, debit card data. It's not perfect, right? So it's not like you're getting all of the transactions that took place. So we don't know exactly what the sales are, but there's a pretty big sample here, and it looks as if, at least based on those observations, that at some point year-on-year sales may have actually flatlined or even turned slightly negative. And as I previously pointed out, there is inflation. Let's call it 3% inflation. So if you're not growing at 3%, which is essentially where, on an annual basis, which is essentially where Lulu was at the beginning of the quarter that they're about to report this week on the 4th. They're going to report after the close. Anything less than that, and actually in inflation-adjusted terms, you're not even flatlining. You're not even keeping up with inflation. So this is as much as anything, it's a bit of a trade update, I guess, on what we talked about on the 24th, because now we're probably looking at something in the neighborhood of a 9% implied move according to the options market. Now there's, as I previously said, there's a mathier way and then a fairly simple way. When you're dealing with an event that takes place within, the week that you happen to be observing it, which is the case here. Actually, this says it's going to be reporting on the 5th. For some reason, I thought it was the 4th. I could be wrong. Still, that's this week. Actually, you know what? Let's double check that. So we'll go to Lululemon Investor Relations and just see what they have to say, just so I can make sure I have this right. In any case, we've got the jump on it. So upcoming events, December 5th. My mistake. I said the 4th. It's the 5th. So this is going to be taking place on Thursday. They're going to be releasing their third quarter results. In any case, you can calculate the implied move by just taking a look for those stocks that have options that are expiring the same week as the event. It's pretty simple arithmetic, right? So the closest strike to the current stock price, around 335. So we can just take a look at the value of that straddle, and we'll take something in the middle. This one's closer to 15.5. These puts are 13.5, 15.5. Let's just call it, to keep the math easy, we'll call it $30. right? So slightly less than 10%. 9% of the current stock price is the implied move by the end of the week. So since we discussed it on as, a name to be long in the space, it has outperformed. It's up nearly 12% total return. My thinking is, and I generally lean long. Everything we previously said on a relative basis remains true, but it does also appear that there's a chance that their growth is slowing even more quickly than the street had predicted. One quick thing I wanted to point out, and I'm going to show this, I believe on this alternative data, so whether it's Placer AI, which is monitoring the actual foot traffic, or Bloomberg Second Measure, which is where I'm getting some of this debit and credit card transaction sample data. One of the things that we might be interested in is just how closely that ties out to the actual data. And so what do we have here? So the adjusted observed sales, that's this number here. So the revenue number, which is slightly below the street number. And one other thing, if you look down here, let me see if I can expand this, because I actually think this is kind of, oops, can I get that? No. Expand, how do I, all right. Well, I wanted to expand that. Usually you can do that. So these columns down here, and this was the last earnings, these columns indicate whether or not the sample observations fell short of or exceeded or matched, in that remarkable case, the estimates. So the consensus estimate, which is again just the sort of average of all of the folks that are covering it and reporting a number. And what we can see is that in this whole 90-day period, there were only 2 days where the observation suggested that the number was beating what the consensus was. So, with that in mind, again, is it still cheap relative to Nike? And actually, frankly, to almost all of its athleisure, athletic apparel comps. So, we can take a look here. Yeah, so you can see that, well, this is just the versus the trailing. Let me see if I can find one that's versus the forward numbers. Yeah, we can see that there's only one, Puma, that trades cheaper. So the mean for the entire group is 23.5. S&P's, we'll call it 25.5 just to keep the math easy. Puma's trading 16 times. So this is still the cheapest in the group. Product is still well thought of. They cater to a more affluent demographic. I've brought this up a couple of times when we've been talking about anything consumer related, because we have seen a sharp divergence in the performance of those businesses that cater to more affluent consumers and those that don't. But all of that said, my thinking is that if you're long the stock, or if you're in earlier strategies that we talked about in this name, it might make sense now going into earnings to at the very least adjust it so that your exposure, that we can at least lock in some of the recent gains, right? So that most recent 12% worth of upside. How can we do this? Well, we could sell the stock and just buy call spreads, but then you have to pay the decay. We could use something like a call spread risk reversal or a diagonal call spread risk reversal. That is probably my inclination here. So in this case, you would buy, it could be, say, a 340 call or even a 330 call, which is slightly in the money, but I'm just going to use the first out of the money strike, which I usually do in these examples. Let me see if there's another. It's going to go out to March just to see if we have. No, we don't. I wanted to see if we. It's unlikely when you have a $300 stock, you're not going to get $5 strikes. But actually, this one we might have it. Yeah, we do. So Jan 10 weekly. So that's going to capture the holiday season, 40 days. Might normally want to capture a little bit more than that. but just allows you to tailor it a little bit more closely, and then maybe sell some near dated premium against this, both upside and downside, such that the decay will be offset, and that you will have, we'll call it the implied move to the upside. We've already said that's about 9% of the stock price, $30 this way or that. Maybe we can give it a little bit more room, take it up to 370. And you end up with a structure that looks a little bit like this. Now, bear in mind, this is going to be the payoff for this trade as of this coming Friday. And this standstill profit is probably a bit overstated, because this is not accounting for some of the vol crush that's going to hit those Januaries. But ultimately, it's probably going to have a standstill yield that's pretty close to neutral. But the downside here is that you're going to end up owning the stock, if it disappoints, at $3.30 a share, right? You'll be put the stock. And the upside you have through the end of the week is only going to be capped by that 370 call that you're selling. So $35 or 10%, more than 10% potential upside here. And then assuming it falls within this range, well, you still just own those January calls, and we would look to try to sell some additional premium against them. And this is basically because we've seen, what got me looking at this was not only the fact that we had earnings, but just the fact that it has materially outperformed. That was our expectation. So that was good. Obviously, outperformed, I think, what did we say, 11, 12% outperformance versus Nike, which was the comp that we were comparing it to back on the 24th. I'm just going to we'll just put that in one more time as a reminder. So we were looking at Nike as our comp. Okay, not quite 12%, but pretty good, right? So 11.84 as of today's close versus 57 basis point. Nike's been dead money, and outperforming the S&P too. So this was one of those trades we like, and I think some of the things that we were saying remain true, but it's a good move in just over a month. 5 weeks, 12%. Might make sense going into a catalyst like this, that you don't have the downside exposure to give it all back. So something like what we just described, which is a diagonal call spread risk reversal, might be a way for us to deal with that. Okay. So, by the way, if anybody has any comments, questions, or concerns, be sure to put them into the chat, and I want to make sure I've actually logged on to the right one, because I don't happen to see any. But maybe everybody's still on vacation, eating leftovers, little tryptophan, something like that. Okay, there was a question. Okay, I'm being told there is a question. Yes. Here we are. says, hi Mike, VIX is now back down to lower levels. Seems like a fair amount of complacency currently. Any thoughts on a long 15 VIX call into Feb or March? Thanks. So, I agree with you. It is fairly interesting that the VIX is now sub 14 again. So let's just take a look at the VIX itself, and then we're going to talk about that structure, or whether there's something else that makes some sense. Okay, so let me see. Let's look at a 5-year chart. Okay, and now we're going to annotate where we closed today, which was 13.34, so that we have some historical context. This line, can I get it? You know what? That's close enough. And I think it illustrates the point anyway. So the white line is where we are now versus the 5-year. Right? So we can absolutely see that the VIX is, getting down towards kind of a lower boundary. Here is the issue. So could you buy something like a Feb or March VIX call? You could. bear in mind, so you probably, if you're asking the question, should I buy calls in the VIX, then you probably already know something that some here may not. And yeah, I see that there's a question about ON holdings, which we'll get back to in just a second. That was when I last spoke about LULU. Because, yeah, that's another Holly index name. I forgot to mention it this time. So the VIX index is a rolling calculation. We refer to that as spot. So when people talk about the VIX, that's the one I'm highlighting right now under the description spot. The VIX index itself is not a tradable instrument. It's a calculation. That calculation is done based on the value of a strip of SPX options 30 days out. So that means that today it's going to look out until January 1st in theory, and tomorrow January 2nd, and the day after January 3rd. And so every single day you're looking at a different strip of options. The options that are going to be included in that calculation are, and by the way, if there are no options that expire on precisely that date, and I just gave the example January 1st, there are no options that expire exactly on January 1st. Why not? Because the market isn't open on January 1st. And so even though SPX now has dailies, so what they do in that case is they actually interpolate the values from the expiration just prior to and the expiration just following where that gap exists. Okay, so when they're calculating, and this, what I'm about to go into, and I apologize if it's a little bit wonky, but knowing this may help you understand why the VIX rises and falls along with the S&P. So the way they do this calculation is they include a strip of options, all options for which there is a bid, up until and unto you have 2 consecutive strikes of options that have no bid. So meaning that on the put side, we could go down to, well, these probably still have a bid, but there we are. So in this case, you would include all options down to the 3,000 strike on January 2nd. You would not include any lower strike. Why? Because the 2,800s had no bid, and the 2,600s have no bid. So the 3,000 strike, and that's nickel bid, so they're all but worthless, relatively speaking. That's the equivalent of a half a cent bid in a SPY option. So you're using a strip of options from 3,000 up to, and then we'll just go to the upside. Now we're looking for options that have no bid, 7,000. 7,200, 7,400s, no bid there, okay? So it's going to, the strip of options that are being used to make this calculation run from 3,000 on the downside to 7,000 on the upside. Now, before I get to the next part of this, think about that for a second. And what you begin to realize is that, well, if the S&P goes higher, then probably those strikes move higher too. And that's true. As it goes higher, the value of those downside puts goes down, so you might actually get to a point where the 3,000 puts have no bid, and so now you're looking at the 3,200s or the 3,100s, and maybe now you have a bid in the 7,200 calls on the upside. So what that means is that not only is the expiration of the options that you're looking at to calculate spot VIX changing every single day to a subsequent day, but it's this strip of options that are being observed goes higher and lower with spot S&P. Now, why that's important is because of skew. We know that upside options tend to have lower implied volatility than downside puts. So even if, and I'm just going to go right to the January 2nd options here. I'm going to get rid of this, and we're going to put strikes in. All right. So there you go. So you can imagine, just imagine that you're selecting all of these strikes. Obviously, it's a bigger window of strikes, but you can see that if the implied volatility of these options didn't change at all from one moment to the next, but the S&P rose, as it goes higher, you're sliding towards the right here. So the strip of options is going to be lower implied volatility options than the ones to the left. This is the reason why instantaneously SPX and VIX are highly anti-correlated. S&P ticks up, VIX ticks down. S&P ticks down, VIX ticks up, because you're just sliding, if you will. The strikes you're observing is sliding up and down this curve. It doesn't look like a curve, but it is a curve. The other part of this calculation, and you can go to the SIBO microsite. They have one where they have a white paper. You can do all of the math. But they're essentially trying to create a flat Vega curve, kind of like a synthetic variance swap. The lower the strike of an option, mathematically, the less Vega it has, all else equal. And so the strip is actually weighted so that you count more of the lower strikes and less of the higher ones, so that you get that sort of flat variance profile. Again, the math isn't hugely important, but it does mean that there might be more of an impact to the lower strikes in the calculation than would be your initial intuition without that. Okay, so we've now addressed spot VIX. So what's the important thing to think about if you're going to trade options on VIX? Well, if you're trading options on VIX, since spot VIX is just a theoretical construct, it's just an observation, kind of a forecast, if you will, of volatility based on a rolling strip of S&P options. Well, you have to have some instrument you can trade, and then you have to have and then you have options on that. And so for that, we have VIX futures. So when you're looking at, say, trading, you were looking at Feb or March, you would be looking at the February or March futures contract. And you'll notice that the futures contract is not trading at the same level as spot VIX. The Feb monthly future is trading 16.6 almost, and the March is 16.9. So if you were going to buy a 15 strike option, that's actually relative to the future, it's in the money. And here's something else. The normal condition is that you get this kind of a term structure. So this is basically the term structure of VIX futures. So here's the Feb future, and here's the March future. Now you can imagine as time passes, these futures get closer and closer until they eventually, they expire and they converge to spot. Assuming that the term structure is, maintains this shape, it's sort of an additional form of decay that those call options are going to experience. So let's just take a quick look at that and think about what the implications are. So imagining that nothing happened to VIX and those just progressively got closer and closer to spot and eventually converged to spot. You bought a February 15 strike call option. Well, let's take a look. The February 15 strike call option right now is about $2.70 a contract. So that future needs to essentially converge to a spot level of close to 18, right, before you're going to see profits. If you bought it at 270 exactly, then it's going to have to settle to 1770 is the break even on the contract. And that's not an immaterial move. There is another interesting thing to think about. So let's just look back. So let's look to the highest. So also the front end of the curve moves around a little bit more. So I'm just going to take a look at the highest point of VIX so far this year, and that would have been right around July. Okay. And now we're going to look at what that curve looked like in late July. So can I install a custom date here? I want it on there. Okay, so now what we're looking at is this was the shape of the curve. That can't be right because that was, I want spot VIX. Let me make sure I have the exact date. I think I missed that. That was... I did miss it. That's why. I should have known that, of course. Remember, August 5th, that was a big day. So actually, I want the 5th. Okay. So I want you to just think about this for a second as well. So the white curve is where we are right now. And this is sort of the conventional term structure shape. Longer dated implied volatility for the index in general is going to be higher than spot. And now take a look at what it was when it really spiked. This will help you contemplate what will happen to your futures contract instantaneously if we wake up tomorrow and for whatever reason something disastrous happens and VIX blows out to 30, what it got to here. So it settled that day at 38.5, which would be a huge move, right? So we're at 13.5 now, 38.5, so 25-point increase in the VIX. Notice, so here's our Feb contract. So that's going to be the, third one out. That is not going to be quite as responsive either as spot VIX at the front end of the curve or the next expiration or the next and so on. So in addition to the fact that those call options, this is not to say that there's never a reason to buy them. I'm just trying to lay all the problems out ahead of time. You have this term structure issue, so it's sliding towards the front, which means that the decay is probably greater than you think. You're buying an in-the-money call option to begin with that's actually all else equal going to converge to spot, and which in the normal circumstance will be lower. It's also going to have less responsiveness. So if you're thinking, what about March, which gives me more time to expiration, it is going to have less convexity also. So this would be the next one out, right? So the further out you go in time when you buy VIX call options, the less responsive those calls are going to be if spot VIX spikes. And I think this is not something that everybody kind of is, it's their natural intuition because they're looking at spot VIX, but then when you look at the future, you realize, oh, wait a minute, that doesn't move quite as sharply. And so that's just a really important thing to think about as you do this. What's the alternative, right? So is it beneficial, therefore, to take some other form of exposure to volatility that's going to give you maybe a little bit more juice? Well, things you can do is you can try to trade SPY or SPX options delta neutral. They'll exhibit some of the same thing. There's no arbitrage, right? So longer dated options have less gamma, which means that how much shorter you get as the market declines on a straddle or a strangle or delta neutral options, there's going to be less to it. The changes in implied volatility are going to be more muted in the same way that they are here. We can play the exact same exercise, and we're going to see the exact same thing. So we just remembered August 5th, big volatility day, so we can take a look at the term structure for S&P volatility. Here it is today, and now we can just go back to the 5th of August of this year, and we're going to see a very similar dynamic. See? So the front end went up much more than the back. But I will say that, sometimes I kind of like trading the underlying plus straddles or strangles. And usually what I will do is something like an SPX strangle. And the reason I'll do a strangle is so that my vol doesn't just go away from me. And what I mean by that is that if the market drifts higher, I'm going to drift towards a long strike, and I'll still have some volatility exposure. I just need to hedge my deltas a little bit with the underlying. And I usually use SPX options versus SPY to hedge the deltas just because it's easy to trade. So that's something to think about. I do believe that we've got plenty of things here that could cause a volatility spike. We have elevated valuations. I think that by itself, not a trading tool, but it certainly makes us a little bit more vulnerable. And I think we can safely say that that's the case here. We are dealing with a presidential transition. So far, that looks like it's arguably a little bit smoother than we thought it might happen. So, something to think about. But we also have a lot of geopolitical risk. I'm concerned about escalations in Ukraine. I'm hopeful, I think, that we're not going to have anything too meaningful between now and the inauguration. Here's my thinking on this. And, everybody can sort of have their own sort of feelings about this. My thinking is that whatever Biden should do at this point, so authorizing the use of U.S. missiles into the Kursk region, that seemed like an escalation. There was a lot of saber rattling by the Russians when it happened. But the Russians also know that there's going to be a change in the administration. And, the number of arms that they could do that with was finite. We had an acceleration apparently in arms deliveries. I saw it reported this morning that Biden was basically trying to create a weapons delivery surge to Ukraine, presumably in anticipation that the incoming administration is less favorable towards supporting the war indefinitely, and that therefore might start cutting aid to Ukraine. So the current administration is trying to accelerate it. Well, if that perception is shared by Russia, and it is also shared by Ukraine, Russia would have little reason to act at this point, because they might think that, this headwind of NATO aid to Ukraine is going to slow, and that would improve their odds. Or at the very least, there might be some effort made to negotiate some form of a truce, and encourage Ukraine to go to the bargaining table by saying, we're not going to support this indefinitely. In any case, that would make it less likely for Russia to do something that would be a profound escalation that would prevent that from happening. That's my theory between now and the inauguration. I I studied the region a little bit when I was in college, there and the Middle East, specifically Iran, and that. But that was right at the time that the Soviet Union was falling, and it was a very different world. I mean, we're talking about an era when there was kind of a tacit understanding that we wouldn't have a meaningful NATO. I think Jim Baker was basically saying, look, first we had Reagan was before I got to college, but in any case, the idea was that, we're not going to expand NATO, and, the Cold War is going to sort of dissolve into an understanding that, a couple fringe countries could join, but countries like Ukraine would not. And I think that, although I think it would be safe to say that some of the concepts that the Russians thought they understood from the Jim Baker era haven't actually come to pass, and that they have felt like there has been meaningful NATO expansion. Many countries have joined. And I think that's sort of escalated the tension in the region. Certainly not trying to defend Putin's kleptocracy at all, but we sort of have to observe both sides to understand that. Okay, so I think puts on SPY or SPX or a combination of those delta neutrals probably the way I would play it. And then just roll that. And if you're dynamically hedging, you're going to realize some of that volatility. And so you're not going to give away all of the premium you spent. It will have a cost. We expect the realized volatility not to keep up. It usually doesn't. But you're not going to give away all of it. So probably buy strangles 45, 30 to 60 days. So call it 45 days out, and then hedge your gamma. And I think that's probably the way that I would play that. But I'm not expecting a huge conflagration before the inauguration. I hope that helps. Okay. Alex V says, the last time you talked about Lulu, you also mentioned ON Holdings. Yeah, and Vuori and ON Holdings, because I happen to observe that within our own household, demand for Nike goods seemed to have essentially come to a stop. And ONON, is ON Holdings, had picked up. And in fact, I was given my first pair of ON shoes as a Christmas gift. Was it last year? Maybe 2 years ago. Actually, the tennis shoes I use most of the time now. And this is this is kind of the real growth story. This and Vuori, but Vuori, that's not really all that. It's not something we can trade. So, this one, taking a look, it still trades at a pretty chunky multiple relative to growth, but it is growing quite meaningfully. I think we can, and let's see if we have this. I don't know if I have any alt data on this one. So this is what we were just looking at for Lulu. Isn't that interesting? So remember what these bars are here. So the bars are the relationship between observed sales, the sample set, versus the street expectations. And the other thing we can see here is that the street expectations, which is represented by this line in blue, can you guys see that? I hope you can. Here, I'm highlighting it, so hopefully you can. So that is the consensus. And actually, they are looking for, this rate of growth is actually the expectation, which is 40%. So that's interesting. This gap is pretty large, right? So we can see that they were actually beating the street's estimates for, the first 4 weeks, we'll call it, 3 weeks here. And then over the course of the last 3 weeks, those numbers have started to look a lot worse. So they reported back on the second week of November. So we actually have a little bit of time still. So Lulu reporting this week, obviously a little bit more time. That's a little troubling to me, I have to say. Let's see whether anybody is bringing their numbers down at all. Interesting. So it looks like the most recent changes are actually higher. Hedgeye. So for those of you who are familiar with Hedgeye, that's run by Keith McCullough. There's a lot of people. This is a guy who speaks his mind, right? So he worked, in a very real capacity in the hedge fund industry. He used to be on CNBC quite a lot because he speaks his mind and does so quite unapologetically. Let's just say that he doesn't he doesn't even wear velvet gloves, right? He's more bare-fisted than that when it comes to his thinking. And I think that is probably a culture that is, represents their organization. That said, it's kind of nice because they're not afraid to be contrarian. So it's actually impressive to me that they appear to be more bullish on this than they were. So something along the lines there suggests that they're somewhat more optimistic. Look, if you're long the stock, I wouldn't sell it. I favor being long. I favor being long companies that are growing and preferably growing faster than everything in their space, consumer discretionary, and the S&P. And ON, it qualifies on all of those measures. So they are growing faster than their sector. They're growing faster than the S&P. That's all very good. It's just not a particularly cheap stock, but it doesn't take that long for them to grow into this, but that's going to give you somewhat higher beta. So how much is this sucker? Wow, up 120% almost this year. Would I be committing new capital to it? Probably not. Probably not. I will say, I was hearing this on, somebody was making a comment about Nike, and I'm not trying to call anybody out. I'm honestly just trying to remember who it was. I think it was Steve Grasso on CNBC who said, you know, why, if the company is experiencing issues, are they hiring an insider to take over as the CEO? And he was referring to Elliott Hill, who's the new CEO of Nike. And he's a long-time Nike executive. Well, here's the thing. He actually left the company briefly and came back. He'd effectively retired. When he got passed over for the top job, he left the company. And he was at Nike through some of the biggest periods of growth. So you should not, in my view, you should not look at Elliott Hill as, you know, same old, same old. So the company's sales have been declining and, you know, he worked at the company for ages, so he's just going to do more of the same. No, he worked at the company and held meaningful roles when the company was growing gangbusters. And he actually was not active in the management in the more recent downturn. Now, will the same things that propelled the company to success in the 90s and aughts, is that same thing going to work now? I don't know. But I don't think that people should dismiss his ability to get the job done because of the company's recent history, because he wasn't a part of that. He was part of the company's more illustrious earlier history. So I will leave it at that. And, you know, something else to think about, that when we look at these multiples, when we look at these forward multiples, think about what the company's peak earnings was and ask yourself whether they could get back to those levels. So can the company earn $4 a share? Can it get back to north of $50 billion a year in revenue? And what does it deserve if it can, right? So at $4 a share, the thing would be trading less than 20 times. And I think that is achievable. So even though I favor companies like Lulu and in general ONON Holdings, despite its valuation, because of their growth, I think it's worth paying attention to Nike to see whether they do start to sort of turn things around and things begin to level off. So we've got a couple more weeks until they report. They are going to be reporting before Christmas. They report on the 19th. That's according to Bloomberg. We can double check that, but yeah, something to think about there. Okay. UP says, Lulu, sell Iron Condor, the D6, 335, 370, 300. That looks like an Iron Fly to me, rather than an Iron Condor. But we're going to walk through them so that we can just discuss what that means. So an Iron Condor or an Iron Fly, depending on what you... That is... Whoops. What did I do here? That is a bet against an outsized move. So in an Iron Condor, you are selling a strangle and then buying a further out of the money strangle, betting against a big move. And in an Iron Fly, you're doing something similar. Another way to think about it, selling a downside put spread, selling an upside call spread. So I'm going to construct both, and I'll do it for the entire week here. So we're just going to go and take a look at the weekly. And actually, I can put this in here because this is one of the defaults we have. So, by the way, for what it's worth, this is described differently by different participants. I've heard some people refer to what I call a short condor, Iron Condor, as a long condor. and so on. And there's a reason for it, which, if somebody's really interested, I suppose we can get into it. But let's just take a look at this. So if you're trying to look at the implied move, you were using the 300s. I'm going to do something like a 300, 320, and then you add 370 on the upside. And I'll choose a similar amount of money here. Okay. So that would be a structure like this, where you sell the 320, 300 put spread that expires at the end of the week. You sell the 350, 370 call spread that expires at the end of the week. Both of those are $20 verticals, 320, 300 put spread, 350, 370 call spread. The stock cannot be in two places at once, at least not in this world. We're not in the quantum world yet where options are concerned, occupying two spots at the same time. And if you sell this, you would mid-market prices, you're going to get almost $11. So the way to think about this is that the most this thing could be worth if the stock moves violently in one direction or the other is $20, because it either has blown through the $20 put spread or through the $20 call spread. You're going to collect almost 11. Worst case, you pay away 20. So, that's not terrible math if you think that the potential move could be more muted than the options market is currently implying, and more than we've seen in recent history, because that 9% is kind of in line with the recent historical moves on earnings. Sure. So that's the iron condor trade. If you were doing the iron fly, long iron butterfly, short iron butterfly. Here we go. And I'm going to, again, just change that expiration to the weeklies and just make this into the 300, 335 that you were talking about. And the 370s on the upside. There we go. So that's what that's going to look like. So here you're going to collect just over $22, $22.40-ish for that. And the most that can be worth is $35, which is the puts. Oops, hang on. Let me put this. Yeah, we have. It'd probably be easier to. I'm going to put that as put and that as the call, just so that if you're looking at it, it just sort of makes more intuitive sense. But effectively here, you're buying a strangle, the 300, 370, and you're selling the 335 straddle. Also, you can think about it as selling the 335, 300 put spread and selling the 335, 370 call spread. You're selling a $35 spread in both cases. That's the most the structure can be worth if the stock blows out to or beyond the long wings, the 300 and 370, and you're collecting $22.50. This trade will be profitable if the stock is within $22 of the 335 strike straddle that you are selling. Something else to think about as you look at this structure and say, well, what if I didn't buy those wings for which you were paying about $7.11? $7.11 is only 2% of the current stock price. And if the stock, for whatever reason, had an absolutely wild move when they report, and I want to show that that can happen. So, fell almost 13% here, fell almost 16% here, moved upwards by about 12% there. That's the reason you put those wings on. But the other thing to think about is that, how much would that have, spending 2% to save how much? Well, the 300s are about 9%. It's actually close to 10% lower. So that means that in this case, you would have spent 2% to save 5.8%. So maybe just selling premium is okay with you, depending on your risk tolerance, because over the course of time, if you could always sell that straddle for 9% of the stock price, paying the extra 2% away, it would have saved you money in this instance. It would have been almost a break even, right? Because 9% move, but you paid away 2, you would have lost 2 if had you not done it. Kind of a coin toss there, right? You would have been better off in these 2 instances. So, you know, in all of these instances, there's 44 events in all of this history. It would have been a push. You would have benefited, lost, benefited, lost. So, you know, kind of up to you what your risk tolerance is, whether or not you think it's necessary to cover that, and also to which side you would be interested in doing so. But I think that's, you know, the trade that we're talking about when I was just saying as an alternative to being long the stock, where you own longer dated calls and are short some near dated premium against it. Not, you know, you're still selling some premium, but it's not really, I'm going to get rid of this here. I'm just going to bring this up one more time so we can look at this and understand what that looks like. You are still selling some near dated premium. You are still trying to play for that vol crush. If you do the diagonal where you sell the downside put as well as the upside call, you are still going to have the risk of being put the stock. I mean, you can see that there's some similarities in all of these trades. This one has a, you know, like I said, it has some theoretical standstill, but whether or not that works out exactly that way is something else. But okay, do you, Akash says, do you make adjustments for flies involving buying calendars or taking the, sorry, put that in there. Glad that rang on the phone and not into my ear. In the IFP, let's see, or taking the loss if you're outside the range. Do you make adjustments for the fly involving buying calendars or taking the loss if you're outside the range? I'm assuming, well, yes, I do make adjustments. And I think we talked about one last week. I do make adjustments if I still maintain my thesis in general, which is going to depend a little bit on what they say on the call, if that's what we're talking about, right? But yes, I do often adjust the strikes, yes. And, oh, yeah, one quick point. If you do something like a strangle swap, you probably want to make those adjustments quite quickly, because if you the short side of your option structure, that upside call option, if it, let's say it moves to or through your downside put strike, you do a strangle swap. So just very simply, $100 stock, maybe I do a 91.10 strangle swap. It's going to be a high vol name like Lulu, you know, where you actually are going to be doing something 10% out of the money on both sides. But if it falls 10% after earnings, now that upside call option, which expires at the end of the week or the following week, is now 20% out of the money. That thing is zero. So you can cover that thing for next to nothing. You own a 20% out of the money longer dated call option though. And oftentimes what I've seen is that the vol of that can fall on the first day. There's an initial vol crush. And then oftentimes it'll actually squeeze in a little bit more over the subsequent days. So I have seen in several instances where if it blows to or through the downside strike, that you benefit from adjusting your strikes or taking the whole position off almost right away, and not sort of dallying, if you will. So yeah, if that's what you're referring to, then the answer to that is yes. I hope that answers the question. Was put SMCI at 87. Premium to date on your short puts and covered calls was $39. Okay, so your net cost is 48. Current covered call on the 24 strike expires Friday and is well in the money. Evaluating the following. Can roll up on a pullback. So actually, let's take a look at this. So it seems to me that your timing, you must have timed, because we had you're short the 24 covered call. let me see here. I'm curious when you got short the 24s. Oh, right in here. Oh, okay. Right before it rebounded. This is, I guess, when they got their new auditor, I assume, when BDO stepped in. I actually don't know the timing of that exactly. So I know that they lost their first one and then BDO stepped in. So maybe that was the timing. Let's see how much extrinsic premium exists in that 24 strike. Probably, oh, did you mention, oh, it expires Friday. Yeah, you're just going to get called out of the stock. There's nothing to that if it expires on Friday. So if your intention is to continue to try to write some premium against this, then you probably want to make an adjustment. And to what? Let's see. These are some pretty juicy implied vols, I'm sure, still, but Spicy saying buy more shares. I'm going to leave that one up to you. There's a lot of there's a lot of related party transactions going on at the company. And that's a little bit disconcerting to me. So it's interesting. When I was at that conference in Florida, somebody was saying, NVIDIA clearly, wants to continue to do business with them, and they're obviously doing a very good business with them. All fair to say. They had some issues. NVIDIA has been working on this, but you probably are familiar that the Blackwells, that they had some heat issues, heat dissipation issues that have been cited in a couple instances. And that's really Supermicro's claim to fame, right? That they have good heat management in their racks. So, look, I'm a little discomforted, but, when an auditor quits, that's alarming. When there's a lot of related party transactions, that's alarming. Could this thing regain its mojo? I suppose. But I think what you might want to do is, if it was me, I probably wouldn't be adding a whole lot to it because I don't know that much about it. But Jane Street net trading revenue $14 billion this year. They're just amazing. They were a powerhouse, that place. I would probably just roll these things up. I mean, you could conceivably, I suppose, add a little bit if you wanted, or maybe throw in some 1x2 call spreads, right? So that'll, because you own it from a much higher level, 1x2 call spreads on top of the stock would just give you a little bit of a boost. It's a little bit like using a covered call, except that you're essentially using the proceeds of higher strike covered calls to boost your near upside. So how much? Why do I talk about it rather than illustrate? So you're long the stock. So we're going to make a bullish position here. You're long the stock, and you want to give yourself a little bit of a boost. So you're going to add a close to at the money call, and you want to help finance that. So you're going to sell something else against it. So this call right here is about $7. So I'm looking to sell an option that's going to be about $3.50. What option is that? That would be something like these 54s, and I can sell 2 of those, and I get this. So now what's going to happen is essentially I'm going to double my rate of appreciation between 42 and 54, a $12 move, should I get it, right? And if you think that you're kind of stopped out on the downside, now this is something else to Spicy Barbecue's point, and I'm just going to put his message up here, because I think it's worth noting. Look, if more information comes out and it gives you greater comfort, you can actually be comfortable selling some downside premium as well, because the worst case has been eliminated. I don't know that it has personally, because I would need to better understand particularly those related party transactions, but it's well worth considering. What would something like that look like? So you've got this whole structure here, your existing long stock position, with a 1x2 overlay. And you can also potentially sell a a downside put where you'd be willing to pick up a little bit more stock. Give yourself some room. This thing's really chopping around here, as you know, because you sold those 24 calls probably when the stock was 20-ish, give or take. But that's something that you can do, is ways to sell a little bit of premium and gather a little bit more upside. And by the way, if you did something like this, 35 is $7 discount, a 6 of the current stock price. Depending on how much you have, you can also create more creative ratios. Now, that's only true because every call option represents 100 shares. If you've got 1,000 underlying shares of the stock, and then you can do, rather than something like a 1/2, you could actually do something like a 1.5, a 1.5 by 2.5. So with some of that help, financed by the sale of a downside put for similar amounts of premium. Getting your theta down. By the way, your theta, if your complete premium outlay is flat, but you are selling wings and buying meat, you actually will have on a standstill basis, you will probably end up with a mildly positive theta. It doesn't look, all the way to expiration, no. And the reason for this is that the out-of-the-money options are going to decay more rapidly than the at-the-money options as a percentage of their own value. And that will actually exceed that decay up and until those wing options are all but worthless. So you sort of get a shape where you have, you have a positive theta that will then turn negative as expiration approaches, as the wing options really get down to a small amount of premium. So bearing that in mind can sort of help you frame up your trade, but know that you have to be a little bit more nimble, because that theta situation will reverse as expiration approaches. Okay, what do we have here? Can roll up on a pullback? Yes, I would. Yeah, so to your point, I would roll up, but I would also consider, doing something like one of these ratios with it, because what you are in right now is you are short the 24 strike put, but you are short a 24 strike put that does not pay you because the theta's all gone. So if I told you, hey, do you want to sell a 24 strike put that expires this Friday? And you said, okay, well, how much premium do I get? And I said, nothing. Your answer would be, no, I won't do that. So that's the reason you would adjust it. If the trade you're in right now, once you convert it synthetically in your mind to what it really is, so long stock, short a 24 call that expires on Friday, is the same thing as being short a Friday 24 strike put, but you're not collecting any extrinsic premium. You would never put that on today, so you might as well adjust it. And if you do those kind of synthetic calculations in your head when you look at this, it'll probably cause you to be a bit more nimble, because as soon as you realized you were short a put without being paid for it, you probably would have said, wait, I want to turn this into something else where at least I'm getting paid for the risk I'm taking. Not that the risk is enormous, because the truth is it's probably not going to fall through 24 by the end of the week. But it doesn't matter whether that's likely or not likely if you're not being paid for that risk, right? If you don't get paid anything for it, it doesn't matter how unlikely it is. You just don't want to be in that position. Okay. I personally like Pat Gelsinger, but I can see why he left today. Stock went crazy today. Yeah. Okay. Oh, I've just been reminded that I've been carrying on for well over an hour. And Intel, to your point, that was interesting. 3 years at the helm. Let's talk about that on Wednesday. So we're going to be doing another one of these live streams, as we typically do on Wednesday at 4:15. Intel's kind of an interesting situation. Are they going to be able to turn that story around? We probably can touch on that on Wednesday, and we probably should. And if you guys have any other things that you're interested in that we didn't touch on today, I'm sure to be looking at some other stocks that also have earnings coming up within the coming days, and particularly retail names, because I think that's going to be interesting as the holiday shopping season is now in full swing after Cyber Monday today, Black Friday last week. So I'm sure there's going to be a lot to look at, and we will do. And I hope you guys tune in on Wednesday at 4:15 Eastern when we'll be back. Thanks for watching.